Where was that at? I don't see it in our.
I don't know. I think JC shared it actually. I don't.
Hello, everybody, and welcome to the Gold Rush. Today is Thursday, June 26th of 2025. I'm Sam Gatlin, joined by my very esteemed colleague and co-host, Mr. Jason Perz. How are you doing today, Jason? What's going on?
Oh, I'm good, man. We got some great questions, and this is why we love to get questions from you guys. I know sometimes it might take a second, but we're always trying to get back to everybody as soon as possible. But sometimes it's hey, this is a great idea. Why don't we talk about this a little bit more? And recently I shared something about bonds and commodities, and they asked for a little bit more clarity on it. So we're going to go through that today. Obviously, we're going to talk about gold. Is it over? Is it going to continue? Some of you guys already know my answer, but we'll give you some reasons why we think that coming in. And then what the heck's happening with oil and energy? And then we'll just go from there. So excited to talk to you guys today.
Yeah, let's get into it. First up, Jason, here's a great chart that our colleague, Mr. Grant Hawkridge, put together. So this is the market expectations for Fed funds rate. And I think we all know that the Federal Reserve has been out here not doing anything. They had a meeting, was that last Wednesday, Jason?
Yep.
Yeah, so
Yep.
last Wednesday they decided to not do anything. Once again, everybody was shocked. I think the CME Fed Watch tool had that priced in the day before as 98% chance of the Fed not doing anything. So it wasn't a surprise at all. And the market has kind of been anticipating the Federal Reserve will start cutting rates despite their hesitancy and Donald Trump doing all he can to get them to cut. But it looks like by Christmas of next year, looks like it should be around 3%, and it's currently at like 4.5%, 4%. So it's a pretty significant decline, and that could really fuel a lot of different asset classes, and including a rally in the bond market, a squeeze in speculative growth stocks, a squeeze in base and industrial metals, probably lower dollars. There's a lot of implications for higher bond prices and lower bond yields.
No, I think so too, Sam. And but once again, every year this happens. Everybody goes, the rates can't keep going up. This is putting too much pressure on the market, the economy, and so on. This has to end now. This keeps happening over and over again. Everybody gets a little ahead of themselves. They think that, okay, we're going to get a whole percentage point cut by the end of the year. I think that would be surprising. It's possible. Anything's possible, right? So I'm not going to sit here and say, like, I know for a fact the Fed will not cut rates. But I also know, like, Powell has been the most data dependent, sitting on his hands Fed chair I've seen in a long time. And so if he sees underlying inflation as a problem, we're not going to see rate cuts. I'm sorry. Like, they would have to be something where the 2-year yield starts to drop like crazy, and then he's kind of forced to do it. But that's the only way.
But Jason, you have continuing claims making new cycle highs. I think a lot of people are pointing to the labor market as a major reason for the need of rate cuts in the United States. So how do you square that circle?
Yeah, I think it's the same thing, that we're looking at. One is, when you're looking at those, understand what Powell's really paying attention to. Is he paying attention to that, or is he going to pay attention to inflation? I think he's paying attention to inflation over just about anything else.
But doesn't he have a dual mandate?
He has a dual mandate. This is why a couple of years ago I was in the camp, hey, like, we got to start cutting rates soon. Like, he's going to cut it. And I've seen every single, now granted, remember, we've been trading mainly not in a commodity cycle. As long as I've been trading since 2008, I haven't been in a major commodity cycle in a long time. So I haven't seen inflation really push the Fed chair's hands at any moment. And it really didn't even in the 2000s either. So claims and jobs were always what brought them to lower rates. But now it kind of looks different where it's like, hey, if we let inflation get out of control at all, we're going to see this thing show up in a really bad way. So they're kind of being very data dependent here. I still think it's the Fed, right? So in the back of my mind, I still have this idea, which is they will always be behind the curve. They at some point will cut rates, and it will be a bad time for them to cut rates, which is just the normal run of the Fed. So it's going to happen at some point. Is it going to happen to the degree that this year is saying? I doubt it, but I think we're going to cut this year at least once or twice.
Yeah, and you mentioned we're not really in a commodity cycle, but I think that's about to happen here, Jason. I mean, you brought along this amazing chart of the yield curve overlaid with the CRB index. So you can see here very clearly with your blue arrows that each time this goes below the zero line and then crosses back above, there's a huge move in the commodities markets. You've seen it every single time. So are we betting this time's different and we're not going to see a big move in commodities, which a lot of this index is crude oil and energy? Are you going to bet that's not going to be the case? We're not going to see a rally there as this crosses back above the zero line?
Well, I think this is one. What I said earlier was we haven't traded through a legit commodity cycle, but I think we're at the beginning. I think that started in 2020. If I really,
Yeah.
gun to my head, absolutely started in 2020. We see it. We're just moving sideways now, consolidating and ready for the next move higher. So I do think that we're still in the uptrend in a commodity cycle. I just think it's cooling down right now, which makes sense, but I think it's about to take off once again. Now look at the yield curve. The yield curve is now breaking out. This is something that is very significant. Whenever this thing starts to get positive, we usually see pretty big moves in oil and energy. So I do
It's a
think
pretty great timing tool as well, Jason. I this is not a chart I look at that often, but this is very helpful and it's really nailed it each time.
it's a great timing tool, even better for gold. But this is the reason why you and I always talk about gold leads the commodity cycle.
Right.
Like gold really leads the commodity cycle, really tells you everything. Oil's a little bit more finicky. It's going to take longer. It really takes global growth for this thing to take off. So as we're looking at the yield curve, when you see this thing inverting, that means global growth is slowing, the economies are slowing down, money is tighter. And so coming out of that, when it's steepening, meaning moving up, that means that money is getting pushed into the market. We call this the velocity of money. So we get more money into the market very quickly. And this adds to the commodity cycle. So it puts money into different things, different assets. As global growth starts ticking up, you start seeing it turn up in other areas like copper, like oil, and the energy stocks. So I do think we're at that point where like this thing's about to take off. And, like once again, it's going to be just like we had the platinum trade, just like the gold trade. Oh, this thing's not going to take off, you guys. Like it's going to take more time than that. You guys are crazy. And then, probably in the next month or so, we're going to start seeing this thing break out to the upside. I think the CRB is poised to move. I just think it was a bad time, news wise, for a big news related event for that to happen. But I do think that this thing's going to take off. And I do think there's a lot of money to still be made in the commodities complex and especially the energy complex. But it's going to take time. And we got to have a lot of patience here because this thing's shaking out a lot of traders. And when traders continue to get shaken out and there's nobody left to sell, that's when things really head to the upside.
That's so true. Yeah. And you also brought along this chart of the yield curve here in the United States. So you have everything here. You have the 30, the 20, the 10, the 5, the 2, the 3 month, the Fed funds rate, all of them here. And you can see clearly, like this last chart showed, this is wave one off the bottom and then a wave two correction. It's a very similar picture here. You get that huge momentum thrust off the bottom and just turning sideways here. Am I reading this how you are, Jason? This is just a wave two. We're about to get a fresh leg higher in these yields. But we were talking about lower yields at the top of the show, but this chart looks an awful lot like this commodities index. So what do you think here? Are we going back to zero or are we going to double-digit bond yields, Jason? Which one's first?
It's a tough one, right? So when we're looking at this chart, you have to think like, okay, what are the long end of the curve? What is the long end of the curve doing? And that's the darker line that you're seeing at the high. That's the 30-year bond. So the longer end of the curve is moving higher. Slowly, but surely, it is moving higher. As we get to the shorter end of the curve, this is what the Fed controls, anything from the 2-year, 1 year, 6 month, 3 month part of the curve. So that's moving lower. So when that scenario happens, this is a really good time for stocks to move higher, for commodities to move higher. It means money's getting thrown into the system. Why do I say that? Well, money's getting thrown into the system because banks can borrow. I mean, you guys don't go to the bank and ask for a zero interest rate loan and get it. I mean, if you do, please give me a call. I've never gotten one.
I would love to have one of those.
But this is where the banks lend from. So the banks lend from the shorter end of the curve. So when that's at a lower rate and the longer end of the curve, which is the 30-year, which is 30-year mortgages and so on, when that's higher, we start to see money flow into the system because the banks are able to make a lot more money. Basically, if you're able to loan at a 3%, get a loan at a 3% rate and then loan it out at a 5% rate, you're able to make a lot of money. So that's what they're doing, which creates a lot of money in the system, a lot of money in the markets. And this creates more money to flow into wherever. I always say inflation is finicky. Sometimes it runs into stocks and people go, well, that's not inflation. To me, it is. You're making prices go up somewhere and money can flow anywhere. So wherever it flows, it's going to end up. So sometimes it flows into stocks. Sometimes it flows into commodities. Now is a perfect time for it to flow into commodities. The setup's there for this to happen. But really, it all just depends on, can the Fed keep their rate at a low rate for the Fed rate? And can the 30-year continue to move higher? If that spread keeps happening, we're going to have a pretty vicious commodity cycle going forward.
Hey, that sounds good to me. I'm here for it. We've already seen a pretty vicious cycle here in gold, Jason. We broke out on March 4th of 2024 and absolutely ripped higher in gold. Look at the momentum profile here. So this is the 14-day RSI. Not getting anywhere close to oversold during this entire uptrend. And here it is, to me, this is just another continuation pattern within a long-term secular uptrend in gold futures. I've had several people ask me if this price action in gold is constructive here. To me, this is incredibly constructive. This is exactly what it did at the previous Fibonacci extension levels. This is what I have been anticipating, and it's playing out exactly how I thought it would. So, to me, it's just a matter of time before the bulls take out 3,400 and take gold futures close to 4,500. We could be sitting here at the end of the year, Jason, and gold is trading at $4,500. Who had that on their bingo card coming into 2025? I don't think a lot of people did.
There's been so many of those this year. There's like gold, who had $3,500 gold on their bingo card. We've been talking about it. Sure, we have the targets, we've been long it, but predicting it perfectly, it's a little hard. But once again, Sam's been talking about gold hitting $8,000 by the end of this cycle. So, we've been trying to give you guys the right targets. These targets have been playing out really well. Sam's been mocking them up every single week for our subscribers. And really, to me here, I think this thing is headed. I think 5,000 is not really far off for the end of this year. Sounds crazy. A lot of people are going to go, "Oh my God, that can't continue to happen," but it can. And the thing is, you just want to go back and look at how assets move over time. Gold is a huge market. It's not easy to move it up, but why is it moving up to the levels that it's moving up? One is you have central banks buying the crap out of it right now. That's something that we haven't seen in history to these levels. So now that's really happening. Could be things like regime shifts, could be another thing like they want to protect their own monetary policy, their own monetary supply, whatever it is. There's a bunch of reasons. And now we're starting to see the public get involved, which Sam and I have been talking about like crazy, which is the cycle works out the same every single time. Like everybody goes, oh, look, gold's moving. Rest of these are dead. Why would you ever own gold miners? Why would you ever own silver? Silver's dead. Central banks aren't buying silver. Platinum, central banks don't even know what that is. Like people kept coming to us and saying these things over and over again. And it's like now platinum is the leading asset of the year, which is mind blowing even to me. Like, yes, we've been talking about it moving. We knew it was going to take off, but taking off to 50% year to date pretty quickly is pretty wild to see. But I do think that this is probably going to continue. I think once we get over 34 or 34, 38, I think we're probably headed to 4,500 pretty quickly. And it's been moving like that. Now, once again, just look at the chart. Like each breakout takes a huge leg higher very quickly. So I don't think it's really crazy to say like 4,500 by year end, 5,000 is possible if we overshoot that. But the next leg higher, and remember, here's another thing for everybody to keep in mind. August, July to August is usually the big peak months for gold. You see gold when it runs have these huge peak months around July and August. And that's where kind of their blow off tops kind of happen. So either it's going to go sideways after that for a little bit, possibly till into December, or it's just going to keep running. And so I do think that probably in the next couple months, we'll probably see that 4,000 handle on gold. So a lot of people are going to say, I don't know, this thing's run a lot, but once again, you just don't bet against uptrends, and I especially don't. So I will always trade on that side of the trend. This is a huge primary trend, and it's bringing the whole sector with it. I think there's a lot of money still to be made here.
For sure. Since this broke out on March 4th, 2024, can you guess how much the silver miners are up, Jason?
No, but I know you have the data.
It's 102%. Who had that on their bingo cards?
Sam
These
has
stocks
the
have
technology.
absolutely screamed higher. It's been awesome. And here, I mean, we talked about this chart earlier, Jason, with this commodities index, and it's a very similar story here with gold. You know, it just moves a little bit sooner. You mentioned earlier that gold rings the dinner bell for commodities. So if we're betting on this chart, the CRB breaking out, that'll probably happen after gold futures make a fresh leg higher out of this consolidation here, right? Because gold rings the dinner bell. Is that where your head is at?
I think gold's gonna take off and continue to take off as long as the shape of the curve is right. And as long as money's loose, it doesn't mean that, we have to be moving up and this curve has to be steepening for it to happen. It just means it has to be above negative. If the yield curve inverts, that's going to be a huge problem. It'll put some pressure on gold. It just means money's tight. And when money's tight, it's a problem for everything. It's the reason why everybody looks at the yield curve and goes, it's the end of the world. It's not only the end of the world. Everybody thinks that happens every time. Really, what happens is it goes inverted. It takes a little bit of time for that to come into the system. During that time, you'll see other assets, stocks, even gold will move up higher. And then at some point, it puts a lot of pressure on it. And you can see that in the charts if you're just looking at it. Look at it compared to what was that 2021, the 2022. You got that huge dividend gold. You look at it in 2019 was one of those. You got a huge dividend gold after it actually made a nice move, but then it just moved higher as the curve moved higher. Same thing in 2008. We saw a big drawdown in gold in 2008, and then that continued to move higher. And then getting back to the early 2000s, there was actually a big drawdown in gold around that time, and then it just moved higher. So to me, it's like this area where it is inverted just gives gold energy. And so if you go back to the 70s, it's something to talk about here for 5 seconds. If you go back to the 70s, you'll see that there's the deepest inversions that we've seen until recently. So when we see these incredibly deep inversions going back to the 70s, what happened then? Well, that's when gold had its best period ever. So I think we're in that type of scenario where gold is ready to have its best period once again. And we've seen it so far. I mean, there's nothing that you could tell me that says this isn't the one of the best moves in gold in a year, at least to start a year. I don't know the exact numbers. Sam, you might have actually looked these up so far, but something that maybe we could do at some point. But this might be one of the best years ever for gold so far, especially in the last year.
Yeah, the first quarter alone was historic. I think it was the best since like 1980 or I forget, maybe
Yeah, it was.
1985.
You're right. I remember you
Yeah,
saying that when we were in New York, it was something in the 80s. So
yeah.
that bypasses the whole run that we're looking at from 2000 all the way to 2011. So that bypasses that whole run. That means that we are performing better than that run, which was historic. And now we're here. So I think gold's got more upside to go, and these are the reasons why I'm thinking that still.
It's a great point you made there about the deepest inversion since the 70s. I hadn't realized that, I guess. That's really interesting.
Yeah, weirdo
You know,
Bob traders, we think of crazy stuff.
yes, you do. Let's finish today's show with some copper talk, Jason. We're seeing a big move from copper today. Let me pull up my terminal here. It looks like copper is up 3% today. It's been a huge ripper out of this little coil. I think this one is heading towards new highs before long. We're also seeing a big move from silver. 36 and a half is what it's trading at today. So silver's looking great. Palladium and platinum also ripping. So you have platinum futures up 8% today, trading at 1437, and then palladium futures also ripping up 8.3%, trading at 1156. So these base and industrial metals have absolutely been ripping, and we love. I think the palladium and platinum and silver are all kind of gray area. You know, they're kind of precious metals. They're also kind of base and industrial metals. So you get the best of both worlds. You know, I think they all work together. Like if copper is breaking out, I think silver is going to be working. I think platinum's going to be working. I think palladium's going to be working, and that's exactly the way it's played out so far. So I think that's just going to continue. And right now, this copper to gold ratio is trading at historically low levels. This is exactly where it bottomed in 2009, 2020, and I think it's going to be the 2025 low. And I think copper and base and industrial metals in general are going to dramatically outperform gold from here, you know, and gold has been a tremendous performer so far this bull market. So, you know, I think these trades are going to be really, really awesome, Jason. And I think 550 really is that level to keep an eye on in the copper futures. You know, that's where it peaked earlier this year when we thought we had a breakout above all these former highs, but you know, it's not far away. It's about 40 cents away right now. So what do you think, Jason? Am I right here? Am I missing something? Are we about to see a huge, ginormous, historic ripper in these metals?
You know, it always brings me to a thought you had when you were on the commodity report with me and Kevin a long time ago, and we were talking about coffee, and you mentioned that coffee had this massive base and it could break out of this base. And you know, Kevin said something to you at the time that was like, I don't know, and I was even
The
a little.
fundamentals weren't there,
The
Jason.
fundamentals weren't there for Kevin. For me, it was just like, I don't know. But at the same time, it was like, this is just the most massive base I've ever seen. And of course, I already had a long signal. For me, I'm just kind of like, yeah, but I'm speaking my book. So I don't know, you know, how truthful I am at that point. But for Kevin, it was, you know, the fundamentals didn't make sense. And he was right. The fundamentals were terrible. It didn't make any sense at all. But, you know, you and I kept talking about coffee being possibly the new cocoa and this thing could move. And then that base breaks out and it didn't look back for a long time. Now it's finally looking back a little bit. But once again, when we look at copper, it's the same type of setup. Huge base, long-term base, ready
Yeah,
to
this
break
is
it.
only a multi-year base. I could go back to the 2000s and show a multi-decade base. This is
Yep.
huge.
It's a huge base. Same exact setup, pretty similar setup to coffee, pretty similar setup to something like cocoa.
Well,
So
those went back to like the 1970s, so
sure,
it's a little bit different.
but it's still like that's a huge base. Whether you're looking at a 30-year base or a 10-year base, like what's really the difference? You
Yeah,
know, like at least the way I think about it. Like I don't
that's
know
fair
what the
enough.
difference is there. And not to mention just this one alone, nothing else. Let's say this is just a massive head and shoulders inverted head and shoulders pattern from a continuation pattern from the 20 low. I think this thing's going to take off. I have no reason to think that, like, you know, you mentioned, I think at the time it was $10 copper. Uh,
Yeah, man, the amount of people that have laughed at me when I say we're going to see $10 copper, you know, if I had a nickel for every one of those people, I would be a very wealthy man right now. And
yeah,
I'm still standing beside that comment. I think copper is going to $10. And I think China, you know, when I originally came up with this thesis for a ripper in copper, it was when China was thrusting off of the lows. And, you know, for decades, copper and China have been very, very similar charts. And, you know, I think we're going to see $10 copper, and I think we're going to see new highs in China. I think it's just, they're both going to continue working.
no, I think so too. I think that we're in if we're looking at an international bull market, which my intermarket analysis is telling me that, then why wouldn't copper be leading the way? Gold led the way in a huge way. Now I don't think gold's just going to die here, but I think copper will start to outperform it once again. I don't think that's really crazy to think about. It's part of the reason why when I look at it and so many people are like, oh man, you got to buy bonds here and bond yields are going to go down. It's like, okay, if I look at the whole cycle and I have it in my head at all that copper is going to move higher here, why would I want to own bonds? Why, if I think international stocks, these still have legs, why would I want to own US bonds? And it's for a couple of reasons. Not only, is it going to be a smaller return, but it's also, if we're looking at inflation coming in or growth coming in, what are bonds priced in? This is a thing. Why do bonds move? A lot of people don't know this, but this is part of the lesson today. It's growth and inflation. So if we're looking at growth and inflation, and we're saying that copper is telling us that growth and inflation is going to move higher, why would bonds move higher with it? Bonds usually get killed by growth and inflation. Bond yields, not prices, bond yields move higher with growth and inflation expectations. As those growth and inflation expectations move lower, bond yields move lower. So like this is a huge setup, but it's like, once again, like you and I talk about all the time, it's one big trade. It's a global growth, copper leading, commodities leading, international stocks leading, dollar down type of trading market. And I think that's going to continue. I have no reason to bet against that trend just yet.
I really love that, Jason. And, a lot of people out there are just like rooting for bonds to go up. But, at the end of the day, you just have to quit caring about bonds and like, it's just another asset. You can't force it to do anything. It's going to do what it's going to do. And if what you said is true and bonds are about to make new lows in the foreseeable future, then go with it. Trade copper futures, trade all this other stuff. Like that's where the big money is made, is during these growth cycles. So like that gets me really excited. And like me, like I'm not really rooting for anything, but like if I were to root for anything for me to make the most money, I picture a scenario where copper's breaking out and I'm making a ton of money in these commodities trades, and in that scenario bonds are getting killed. So I guess like theoretically, I am rooting for bonds to get killed, but I don't really care. I'm going to trade any environment that's in front of me. But
I think everybody's stuck on for bonds to for bond yields to go down, and if the Fed lowers rates, I will make all the money in the world. And it's like, have you paid attention over the last couple of years? Have bond yields had to go down for you to make money? And the answer is no, like not at all. Sure, they dropped them just a little bit last year, but once again, when you have enough growth behind the scenes, and once again, everybody's going to go, well, there's not enough growth here, and I don't care. I'm telling you what the market is telling us. Like, how do we get paid? Do we get paid by going, well, I don't like when I go to the store and my friends don't have jobs and this is happening and inflation sucks, and like, does that make you any money? No. But if you go, what's the charts do? Okay, copper looks like it's going to break out. I'm still in gold. It's making me a lot of money. International stocks, Poland. Oh my God, I can't believe how much money I've made in Poland, for God's sakes.
Up 40% this year.
Like I just, you look at these things and you're able to make so much money in all of these areas. And I think that's what it's, as a trader, especially if you're price action based like us, don't care about anything else. Like, don't put yourself in a box and go, yields have to go down for me to make money. If yields going up means the market's going to crash. Don't put yourself in any of those boxes. Follow the price action, do your analysis. Don't get too wed to correlations, and you're going to make money. That's all it is. Continue to take the signals, understand risk management, and you will make money over time. But if you're betting against things or, bond price, I mean, look at a chart of TLT. That's a downtrend. That is a nasty downtrend. I understand why people want to try to trade the bottom. If you're short term, go for it. But once again, that's a downtrend. You're buying a downtrend no matter any way you look at it, how you want to slice it. And maybe there's just not a trade there right now. Sometimes there's just not a trade. Some people will go, well, what would you do with bonds? Well, you don't have to be long and you don't have to be short. You could just look at the charts in other areas like copper and go, I want to be in copper miners. I want to be in gold miners. These things.
Speaking of copper miners, Jason,
let's talk about
looking for copper miners to confirm the strength in the copper futures, and they haven't been this entire time. for months, for years, really. But it looks like they're finally ready to go. Look at it here, breaking a multi-year downtrend line, holding it as support. I think this thing is about to rip, and copper futures are going to double digits. Mark it down, Jason.
And is this chart from yesterday?
This is yesterday's close. Let's see what it's doing today. I bet it's a
Today
lot.
it's up. I'm writing a
Yeah.
post about it today. It's up 6% or something.
Yeah, nice little gap and go. So it's trading up here around 45.
Yeah, so it had a
Yeah.
huge gap and go after the Sam's pointing out this downtrend that we broke. Great signal there, but now we're moving up even higher very quickly. Like basically, it broke out, it retested, it then jumps up 6% today. Huge gap and go. It's still hanging out up there at 6%. Is it, Sam?
Yeah, 45
So,
and a half.
so
Looks
that's telling
great.
me that this is going to be sustainable. Um, the volume would also help. So I'll look at the end of the day volume to really understand that. But like it's, when you look at this, you got to think, okay, bonds, maybe not. Copper miners, I understand a lot of people don't trade copper miners. Like that's not a thing that's on your list every single day, like Sam and me. However, Sam and I will trade anything. We'll be long technology one day, utility stocks. It doesn't really matter. You just want to be in the areas that are showing relative strength and understand the underlying intermarket analysis that can help you position right. But I think copper miners are headed a lot higher. I think, probably if I'm thinking about my most bullish trade over the next 6 months, it's probably copper miners. I probably think
Yeah.
copper miners look the best. Energy's not ready for me to make a call like that, but I think copper miners are.
Yeah, and we'll just finish with this chart of why energy's not ready. It's still this is the energy sector spider. This is XLE. It holds the big boys like ExxonMobil, Chevron, the biggest and the best energy stocks. And look at this, Jason. It's the only sector still stuck below the great financial crisis high. And it's been here for a while. It's coiled up. It could make a move, but at this point you gotta show me. It's been a long time. I'm happy to pay higher prices and see a decisive breakout here, but this is just not something I want to be a part of right now, Jason.
Sam just brought up a great point, which is happy to pay higher prices. That's something that, a lot of traders don't do well enough, which is just wait for an actual signal. Like, if you use a false breakdown signal, mean reversion style traders, great, fine, whatever. But if you're like comfortable with breakouts, there's no reason to be like, okay, well, it's 85. I can't buy this thing at, 100 because I've missed the move. Like if this break, once again, look at the copper chart. If we look at the copper chart, if we look at the XLE chart, this is huge bases that are breaking out. Ralph Acambora always said the bigger the base, the bigger the space. That's absolutely true. So if we see this thing actually break out to the upside, like it's probably going to take off and not look back.
It's going to be a secular uptrend that'll last for years. So like I'm not worried about catching like jumping the entry. A lot of people are interested in jumping this entry. They're telling me it's gonna break out above 90. It's gonna happen.
Mhm.
But I'm happy to pay a little extra and not sit in it and make nothing for months. If copper miners are breaking out, I want to be participating in that. I don't want to be involved in a sideways mess like this. I think that's what it comes down to at the end of the day. It's relative strength, it's opportunity cost.
Yes, and I want to talk about oil just for a second because I'm sure it's on everybody's mind, which is everybody saw the signal, and when Steve and I went on the other day, and even when Dimitri and I went on as well, I was talking a lot about, hey, the signal is cool, but one thing I hate, and Sam and I just talked about this last week, is news-based breakouts. The false breakdown that happened on news is always kind of frustrating like this. That doesn't mean it's not sustainable. That doesn't mean it can't move higher here. It just means it's just knocking your probabilities down as a trader. Doesn't mean you don't take the signal. You take false breakdown signals, take it. But if you're a discretionary trader, I think trading on news is a bad way to go. It's always something that kind of turns into this huge drawback down. But once again, it's hey, it broke out. You take the signal. It really didn't move that much lower than the initial false breakdown signal. So I think this thing might have some more upside. It would have to show me in the next week or so that it's got more upside, and then I could really say that. But for now, I'm not really worried about energy. I don't think it's going to break down, but I
Yeah,
think
I think that's to
Mhm.
me what this move showed me is that maybe the path of least resistance isn't lower. Maybe it's just sideways. Maybe this is just going to trade sideways for much, much longer than anybody thinks. It's already been, what, 3 years of nothing in the futures here for energy? What if it's another 3 years? That would drive people crazy.
Yeah, I don't think it'll be that. I
I'm
just
just
think
posing that
posing the
hypothetically.
question.
I think that is a lot of pain would be inflicted on traders if this just had massive whipsaws back and forth for another few years.
I think
I don't
it's
know.
it's already at the end, and I'll give you my only reason why. It's because when I think of the sentiment behind traders coming from 2018 into 2020, that was a rough period. You could see it right on the chart. Basically, you had this kind of a nice run in oil energy stocks. I think that was 2016 to 2018. You saw it move up a little bit. And then you saw this crash down. I think that was October 2018 to December 2018, and oil hit about $40. And then you see that huge range sideways that everybody was like, it's going to break out, it's going to break out, it's going to break out. That was in 2019. You had something happen in Saudi Arabia. I should look it up because I talk about it all the time. And something happened in Saudi Arabia. Not sure exactly what it was, but I think it was December 2019 or January 2020, and you get this huge false breakdown signal. And then that was the huge washout that ended up in oil and negative $50. I think we're kind of at the point, like if you talk to energy traders or if you talk to people who like have had energy funds. I mean, I watched I'm not going to say his name, but the biggest energy bull I've ever seen just kind of like write this like almost crying post the other day about like him buying these stocks and how he's just getting killed and he's so embarrassed about it. And I was like, wow, it's kind of like it's all the way up here. It's at $64. It's not something where it's hitting negative prices or $40 or something even low. And people are already talking like this is the end of the world for energy. This is the end of the world for oil. So I do think a lot of people got washed out. I think a lot of people got washed out, and I really don't know who's really left to sell. And then when you and I look at the positioning, we're kind of seeing that same scenario play out as well. So I'm not saying jump the gun. I like what Sam said earlier. Like wait for your spots, pick your spots. If you're a breakout trader, above 80s obviously where like the new highs are going to be. If you're a mean reversion trader, you'd like to buy false breakdown signals, you're already long it and waiting, fine. But I'm just saying like wait for your signal. I think the big move is going to happen above 80. That's going to be the most significant way you can buy this thing to really take advantage of the trend.
Yeah, I'm happy to wait. If anybody enjoyed what we had to talk about today, we write two newsletters each week. One goes out on Monday, one goes out on Friday. The Monday newsletter talks all about precious metals, and on Friday we talk about all kinds of things, whether it can be copper, energy, cocoa, coffee, all
Uranium.
kinds of different things. We just talked about oats and the grain markets on Friday. There's so much happening in the commodities markets all the time. We not only outline the futures, but we also cover individual stocks. A lot of gold miners right now. I'm expecting a lot of copper miners here over the next few months. So if you guys are interested in getting involved in some copper miners, don't hesitate to join us at Gold Rush. This is a subsidiary of All Star Charts. We are $12.99 a year, and if you don't like what we have to say, you can get your money back, no questions asked, within 30 days. We have more information in the description on YouTube, so you can check us out there, or Gold Rush at allstarcharts.com.
And most importantly, to me, not anybody else, but you get access to our bond and currency reports.
Yes.
On top of it, you also get bond and currency reports now. So there's a lot of stuff going on at the Gold Rush. So definitely check it out. And once again, just like Sam said, 30-day money back guaranteed. That's pretty good. So hopefully we see you guys there. If not, we will be on next week at 2:30 p.m. Eastern time, and we'll see you then.
Adios, everyone.